Sanjeev Bijli, Executive Director at PVR Inox, spoke to my colleague, Rucha Somaiya, and here's an excerpt of that.
Yes, Q3 has been a good quarter for us. Revenues, as you said, is at about over 1,700 crores. EBITDA is around 258 crores. The margin is still about 15%. We had a very high ATP, high SPH. Both these numbers have been higher than last year. So overall, yes, I think it's been a good quarter. The margins are slightly lower. EBITDA margins are slightly lower than what we had expected because we're still in the process of restructuring our costs. We have saved a lot on costs, fixed expenses and variable expenses. But still, there's a lot of work going on in cost cutting so that we can reach higher margins.
Okay, then what kind of range are you looking forward to?
It's difficult to tell, of course. We're obviously wanting to go above 15% margin. We want to go around 18 to 19% margin. And this obviously will be a result of both higher revenues on which a lot of work is being done and reducing costs.
Okay, and Mr. Pant, if you could highlight on the kind of expenditure also, what could be the kind of margin levers going ahead?
Sure. So, Rucha, as you know, our business is largely content dependent, right? And I'll just give you a brief overview of how the year went by and the quarter went by. So the year was marked by a significantly lower Hollywood number of Hollywood movies that got released and significantly lower Hindi movies that got released. So the box office in terms of Hindi box office collections was impacted significantly, which was largely made up by the Hindi dubbed portion of movies like Pushpa 2, Kalki, etc., which did really well. So going forward, to your earlier question on what kind of margins can we expect going forward, what we have seen is that pre-pandemic, the business used to deliver about 18% odd margins at occupancies of 32.5% margins. What we have seen is that if we are able to deliver 27.5% occupancy margins, occupancy, our margins should be at the 18% level. So it's a matter of content coming back. This year was largely volatile because of Hollywood and Bollywood. Next year, we see Hollywood ramping up big time. Bollywood lineup also shows a lot of promise. The levers on the cost side would largely be, obviously, rent and cam are the biggest fixed cost. So reduction in rent and cam going forward for incremental properties and properties which we can open for negotiation. So those are the primary levers. On the other fixed costs like personal electricity and other fixed expenses, we have given a slide as part of our investor deck, which shows that we are already on a 9-month basis operating on a lower base as compared to last year. So I think content coming back, so that would give us a driver on the revenue side. And then on the fixed cost, rent and control, even more control on rent and cam, I think what will deliver these higher EBITDA margins.
Okay, so in terms of occupancy, because you mentioned that one is going to be a key lever for you. So, Mr. Bijli, if you can highlight on your maybe expansion strategy, say in key markets area, new cinemas, and also in say tier 2 or tier 3 cities in terms of expansion of cinemas, if you can highlight to get a more broader level than looking at the quarterly numbers.
Yeah, of course. I mean, we still remain committed to screen expansion. I think we still very strongly believe that India is very underscreened. And movie going is one of the most popular entertainment options for our country. We're underscreened per capita compared to US, China, and many other developed markets across the world. We opened 70 screens this year, and our strategy has always been to do a mix of tier 1, tier 2, and tier 3 cities. Wherever we get a good property, good developer, good development, and a high movie-going index, we commit to open cinemas there. So 70 screens we've already opened this year. We've opened in Dehradun, Bombay, Delhi, Bangalore, Pune, and also some tier 2 and tier 3 cities. And we're opening 33 more screens in this last quarter. And these are also all over the country. We're opening in Jabalpur, in Leh Ladakh, and in Gurgaon, and in some places in South India as well. So it's always been a mixed strategy to open all across the country, across all kinds of demographics.